stop what you're doing right now. Seriously, if you hold any utility stocks in your portfolio, you absolutely need to hear this deep dive fundamental breakdown. Last week, I literally ran Northwest Natural Holdings through 5 distinct valuation models. We're talking discounted cash flow, dividend discount, the whole works. And then I ran it against the legendary checklist of both Warren Buffett and Peter Lynch. And honestly, what I found totally shocked me. Look, in a market that's constantly terrified by inflation, stubbornly high interest rates, and looming tech bubbles, retail investors are just desperate for a safe harbor. Am I right? Well, by the end of this explainer, you're going to know exactly whether this legacy utility is a screaming Buffett buy or just a massive Lynch value trap. And I promise I'll give you a clear, actionable framework you can just steal for your own stock analysis moving forward. So let's jump right into unpacking the Q1 2026 performance and the actually fascinating future strategy of Northwest Natural Holdings.
Okay, I'm going to start off with a totally contrarian statement. Boring is where the real wealth is actually built. Think about this number for a second. 70. That is Northwest Natural Holdings' staggering streak of annual common stock dividend growth. Let that sink in. They've increased their dividend payout every single year without fail since 1956. Finding a stock with this level of intrinsic stability is basically the financial equivalent of finding a perfectly tuned metronome playing in the middle of a chaotic heavy metal concert. I mean, what would Warren Buffett think about an economic moat this wide? If you're a focused learner looking for an absolute masterclass in long-term compounding, this is exactly it. It completely defies modern market chaos by just giving you a steady, reliable drip of income, no matter what the broader economy is freaking out about.
And the crazy thing is, their recent fundamental performance is fully backing up that history. Their Q1 2026 earnings per share came in at $2.33. That's up from $2.18 in the exact same period last year. But here's the bold question we really have to ask ourselves. How on earth does a heavily regulated legacy energy company actually squeeze out that kind of EPS momentum when inflation is literally eating everyone else's margins? Well, we're going to rip open their income statement to see exactly how they pulled this off, because growth like this in the utility sector, yeah, that doesn't just happen by accident. But before we get totally lost in the spreadsheets, we gotta look at the bedrock of the company. This isn't some flash-in-the-pan vaporware tech startup. This is a 167-year-old utility operating across 7 different states, serving nearly 1 million customers. We're talking about a company that has survived the Civil War, 2 world wars, and countless recessions. They are literally the invisible essential infrastructure of the Pacific Northwest. You know, Peter Lynch always teaches us to invest in what we know, and we all absolutely know that people need heat and water to survive. It's a fundamental inelastic demand curve. So let's look at the actual cash flows supporting this massive operation.
Evaluating their Q1 consolidated income statement, a super fascinating dynamic pops out between revenues and expenses. Notice how their operating revenues actually decreased slightly? They went from $494.2 million down to $490.4 million. So the absolute crucial takeaway here is that their big jump in net income, hitting $97.4 million, was driven entirely by operational efficiency. They somehow managed to slash operating expenses from nearly $340 million all the way down to $327.5 million. It is just a textbook example of how controlling the downside and ruthlessly managing costs can dramatically expand your bottom line, even when your top-line growth decides to take a little breather.
So what exactly caused that increased margin? Well, the primary drivers for this Q1 net income bump were basically new customer rates from the October 2025 Oregon rate case, paired up with a noticeably lower income tax rate for the quarter. These 2 factors swooped in and successfully offset the higher depreciation and operating expenses they were facing during the period. It just goes to show that their whole regulatory strategy, actually going to the state and effectively arguing for necessary rate adjustments, is working exactly as intended to protect shareholder value.
But here's the thing, a utility can't just rely on rate cases to survive forever. It needs real, tangible growth. And they've actually built a highly effective customer growth engine. They achieved a really healthy 2.8% total connection growth rate over the last 12 months, adding over 26,000 brand new gas and water connections. And while they did have a solid 1.8% organic growth rate, a huge chunk of this momentum is being fueled by strategic M&A. Specifically, they acquired SciEnergy down in the fast-growing Texas market, along with a bunch of Northwest Natural Water acquisitions. They're basically expanding their footprint way beyond their traditional borders to capture entirely new demographics. Now, to support all those new customers, they have to deploy capital. And I mean a massive amount of it. From 2026 to 2030, they're planning capital expenditures somewhere between $2.6 and $2.9 billion. Northwest Natural Gas takes the largest slice of this pie, obviously, followed by SciEnergy and NWN Water. But this capital isn't just disappearing. It's entirely geared towards supporting system reliability, resiliency, and driving a projected 6% to 8% growth in their rate base. And in the utility world, a growing rate base is literally the ultimate engine for future earnings because it dictates exactly how much profit the regulators are going to allow them to make. Ultimately, all of that heavy infrastructure investment translates directly into a long-term strategy for shareholders. Their base target for long-term earnings per share growth sits at a nice steady 4% to 6%. But consider the massive potential catalyst here. If they successfully complete the MX3 gas storage expansion project, that EPS growth target jumps up to between 5% and 7%. That single project holds incredible strategic weight for their overall valuation. It is quite literally the difference between standard, run-of-the-mill utility returns and genuinely compelling, market-beating growth. Of course, recovering those multi-billion-dollar capital expenditures requires strict regulatory approval. This multi-year Washington General Rate Case settlement outlines exactly how they're planning to pull it off. It's essentially a stepped approach. A $20.1 million revenue increase in August 2026, followed by $7.7 million in 2027, and another $8.7 million in 2028. This is the exact precise mechanism utilities rely on to recoup their infrastructure investments over time. By staging it out over 3 years like this, they create a super predictable revenue runway that analysts and dividend investors absolutely drool over. And there is just a fascinating, completely objective tug-of-war at play during these rate cases. On one side of the ring, Northwest Natural needs to recover its heavy infrastructure investments, manage inflation, and hit a proposed 9.5% return on equity just to attract investors. But over on the other side, the Washington Public Council mandates that these rates absolutely must remain fair, just, and reasonable to make sure the public isn't being hurt. It's a constant, high-stakes balancing act between capital recovery and ratepayer protection. If the utility gets too much, everyday customers suffer. But if they get too little, the whole infrastructure just crumbles. Surviving that regulatory tug-of-war is exactly what gives utilities their famous stability, and the rating agencies are definitely taking notice. Case in point, NW Natural Water Company was just assigned a stellar A- rating by S&P, and S&P specifically highlighted their stable, predictable cash flows from a regulated business model, fully expecting their funds from operations to debt to stay consistently strong at over 20%. This pristine rating directly supports their ability to finance $65 million in annual water infrastructure upgrades cheaply. Let's be real, in a high-interest rate environment, a strong credit rating like that is a massive competitive moat. So, why do these credit ratings matter so much to the holding company and, more importantly, to you as a shareholder? Well, it comes down to these super strict ring fencing rules. Regulators have effectively built this giant financial fence around the utility. Northwest Natural can only pass those famous dividends up to the holding company if they maintain very specific credit ratings and equity ratios. If their rating drops too low, bam, the dividend valve gets completely shut off. So that A- rating isn't just some vanity badge of honor, it is the literal key to unlocking the dividend that has been growing for 70 straight years. Looking a bit further ahead, the single biggest existential challenge for this stock is without a doubt the climate transition. But they actually have an incredibly strong legislative foundation in the regions where they operate. As local law explicitly outlines, the law supports all forms of renewable natural gas, including renewable hydrogen, which is made from excess wind, solar, and hydropower. This legal framework is essentially the launching pad for their massive decarbonization efforts. It ensures they aren't out there fighting the government, but rather working totally within the established rules to evolve their energy mix. Now, to really grasp their strategy here, we have to understand RNG. Renewable natural gas, or biomethane, is sourced from a variety of feedstocks, which includes green hydrogen and synthetic methane. The absolute brilliance of this strategy is that it's designed to be injected directly into their existing pipelines to lower carbon emissions. This is the core mechanism Northwest Natural is using to comply with strict climate mandates without having to completely abandon 167 years' worth of pipeline infrastructure. Think about it. They don't have to tear up the streets to lay down new electric cables. They just change exactly what flows through the pipes. And they aren't just talking about it in boardrooms. They are actively out there procuring it. They recently issued a formal request for proposal, or an RFP, to acquire renewable natural gas and its environmental attributes. Sourcing this from all around the country is exactly how they plan to hit their super ambitious 2050 carbon neutrality goal while staying totally compliant with strict legislation like Washington's Climate Commitment Act. Honestly, it represents a massive operational pivot from legacy fossil fuels to a sustainable, closed-loop energy cycle, all while somehow keeping that cash flow perfectly steady.
Which really brings us to the ultimate question for this explainer. Can Northwest Natural successfully balance 167 years of legacy pipeline history with a genuinely carbon-neutral future? Will steady dividends and massive fossil fuel infrastructure successfully pivot to renewable energy, or are the transition costs just going to completely outpace the benefits? It is a truly fascinating corporate evolution to watch unfold, and a crucial one if this is sitting in your portfolio. The fundamentals today are undeniably strong, but this energy transition is going to be the ultimate test of their moat. Keep analyzing, keep learning, and I will see you in the next explainer.